Hello and welcome to my next video. Well, in this session, we're going to look at commercial banking and see how those old-time goldsmiths evolved into banking. Actually, not see how that happened, but see actually how they function nowadays would be more accurate. So we're going to see how commercial banks, by commercial, we're talking about like Chase Bank, Bank of America, those kind of companies, Bank First, United. So how they literally create money. This blows some students' minds that banks literally create money. So to understand how that occurs, we're going to have to first look at a portion of the bank's assets and liabilities. So we're not looking at all the assets and liabilities, just the ones that are important for understanding how banks create money. So we're going to look at a T account. So here we look at the fact that banks do have that cash in their vault. That would be in the drawers and in the ATMs and in the vault. They hold reserves on account. More will be said about what that means later. They make loans, and they do hold government bonds and commercial bonds, some, but mainly government securities. And then certainly there's more than one liability that a bank has, but the one that's important for our purposes would be checkable deposits. That's checking accounts. So more about this reserves on account. Commercial banks, at least national banks, are required, and state banks can, if they so desire, hold reserves against deposits. What deposits are we talking about? Checkable deposits. Well, how do commercial banks hold reserves? Two ways. Either that cash in the vault, or commercial banks have, in effect, it's like a checking account with the Federal Reserve System. We'll say more about the Fed in an upcoming video. So here's the kind of cut to the chase. Commercial banks create money when they make loans out of excess reserves. Now, let me make sure that you understand this. Lots of students think that commercial banks make money by the interest they earn off of loans. No, that is not how they create money. That's just income that they're earning off their loans. Banks are creating money when they make loans out of excess reserves, and we'll go through and show how that happens. Okay, but it's not interest rates that's the money creation. Now, interest rate will be tied to the loan, but it's the creation of new loans out of excess reserves that's the money creation part of it. So to understand that, I'm going to make some highly simplifying assumptions. These are a little more simplified than most books, but I think it's easier to understand. So realize that these are some simplifying assumptions. One is that there's just one large bank. Well, we know that's not true, but the banking system is consolidating, and it's going more and more to where all the banks pretty much are about the same and kind of work in tandem. So that's not too far from the truth nowadays. Also, that amount that banks are required to hold against checkable deposits, cash in vault, or on account with the Fed, we're going to assume that that's actually 10%. That is way higher than what the actual requirements are, but 10% is easier to calculate with, so we're going to assume that's true. We're also going to assume that banks, any excess reserves they have, and we'll see what we mean by excess reserves in a minute, any excess reserves are loaned out, so they hold no excess reserves. They make loans as soon as possible out of those excess reserves. Okay, let's get the party started here, so to speak. So let's say that there's 100 new $1 bills thrown out of a helicopter. And so we're going to assume that also people hold no green pieces of paper. Again, that's getting close to the truth. So they would run with those green pieces of paper and deposit that into their checking account or savings account. So the new part of it, we'll talk about that later in relationship to the Federal Reserve System. So let's see how that affects the T account. Now we're only looking at changes here, not overall levels. So the bank now has $100 more cash in their vault. By the way, at this point, those green pieces of paper that were circulating out from the helicopter, that was money. But now the green pieces of paper in the vault of the bank, technically that's no longer money, that's reserves. The money is the checkable deposit increase of $100 in whoever deposited those green pieces of paper. So money has changed from green pieces of paper, now the green pieces of paper is reserves, to a checkable deposits, and that's just as much money as the green pieces of paper. So that's important you understand it. Now, that means that we've had an increase in total reserves of $100. And if the required reserve is 10%, then $10 of that would be required. The bank has to hold on to that. But guess what? Any remainder is excess reserves. In this example, that'd be $90. Banks can do what with excess reserves? They can make loans. So the bank will loan out excess reserves. Again, we're going to assume that they're making the loan in the total amount of the excess reserves. Now, obviously, if you go into a bank and want to make a $90 loan, they'd probably laugh you out of the bank, but we can add zeros to make this more realistic, but the numbers that are small are easier for me to fathom anyway. So at this point, the bank, somebody comes in, takes out a $90 loan. The bank person dealing with this person taking out the loan will credit their checking account with $90. Guess what? That bank has just created money, because now instead of $100 of increase in total deposits between the bringing in the green pieces of paper, now there's the $90 increase in deposits from the loan, and so the total deposits have increased by $190. That's an increase in money. That is money. Checkable deposits are money. So we have increased money. You say, yeah, but the person doesn't take out a loan just to have it sit in their checking account. True. So they write a check, use a debit card, whatever, to buy something. But guess what? Whoever sells them that item for $90, it goes right back into the banking system. And since there's one large bank, the amount of checkable deposits hasn't changed from the $190. So the bank has just created money. That's how banks create money. Notice it's not the interest rate, it's the creation of loans through utilization of excess reserves. Oh, but it gets better than that, because as long as the bank has any excess reserves, they can make loans. So out of that $190, let me back up, sorry. Out of that $190 of deposits and that $100 of green pieces of paper, 10% of $190 now would be $19. So guess what? There's still $81 of that $100 that's excess reserves. So the bank can make a second loan. And again, we've had an increase in checkable deposits. The money supply has increased. How about that? Now, at this point, we look at that same little $100 of green pieces of paper. That's the reserves in this example. 10% of 271 checkable deposits, that would be the 2710, but guess what? There's still 7290 of this $100 green pieces of paper. That's excess reserves. So the bank can do what? Loan it out. So the bank will continue to do this until all the reserves, all that $100 in this example is required reserves. So what you have to do is ask yourself, 10%, remember that's a required reserve ratio we're working with. 10% of what would be $1,000? Well, it'd be $100. So, oops, sorry. So, saying it the other way, the bank can make loans, including that initial $100 deposit and then loans. That total increase in the money supply could go up by a factor of 10. Now, that's not because of the 10%. It is, but that's, you don't just drop the decimal. There's a way of calculating it. We'll say here in a minute. But it's because of the fact that 10% of 1,000 would be 100, and that's what the bank's required to keep. So as long as the bank has excess reserves, that bank has the option to be able to make loans. So now on to how the $100 multiply it out to 1,000. Well, there is a multiplier, and that's called the deposit money multiplier. Sometimes it's all just called the money multiplier. There's all kinds of names for it. But if you don't have any currency drain, in other words, if people's not holding currency, which is in my little example, that's we're assuming that it's 1 over the required reserve ratio. And so 1 over 10% would be 1 over 1/10. So that's where the 10 times 100 to get to 1,000 comes from, going backwards. So that's how you calculate the money multiplier. Just to make sure we're on the same page, if the required reserve ratio, let's say, was 25%, it would never be that high, but the numbers are easy. 25% in fraction form would be 1/4. So 1 over 1/4, invert and multiply, so it would be 4. In other words, that at a high required reserve ratio of 25%, the bank would only be able to expand the money supply up to a total of 4 times that initial deposit, so $400. So make sure you understand how you calculate the theoretical expansion of the money supply. Oh, by the way, this also works the other way. So if we came in and withdrew $100 and it didn't go back into a bank, then the money supply could theoretically shrink by that amount also. It works either way. Now, banks play an important role in the circular flow model of the economy because they are financial intermediaries. That means that they can match people saving with people wanting to take out loans. Now, business firms are big is a big group that takes out loans to purchase capital goods, and then of course we know about households and the governments also, but we'll keep it simple here. So that hopefully explains to you how banks literally create money.